afternoon, everyone. It's a quiet good afternoon. Well, the retail bank had a very profitable quarter this quarter, despite what was in fact a weak economy. Although there are signs of recovery, but the economy is still weak, and we still have customers and clients who are experiencing problems with things like job losses, reduced incomes, and things like that. So our strategy is to target new clients with opportunities, clients who we believe have opportunities for growth and development, and also deepen the relationship to their existing clients within the bank to make them financially better off, so that we can grow our business on the basis of a good, strong, profitable revenue growth. So that has been quite successful for us. If you look at the revenue growth, you will see that we are up $246 million. If you look at the top, you will see non-interest revenue, that remains flat, an increase of $21 million. Notwithstanding all the noise we have in the market about fees and the resistance we have from customers in terms of fees, the fact is that we're able to keep that fee at a certain level, especially because of the growth that we have in loans, and therefore the fact that we kept it there and the fact that we had a little growth is consistent with the loan growth that we have. So most of that was in credit fees. Whether in terms of net interest income, that was up 201 million quarter over quarter, and 251 million year over year. That was a function of three things. Three variables. The first variable is a kind of negative variable. I mean, we had rates declining, and rates declining means declining margins for us ever since JDX. But still, notwithstanding the declining margins, Scotiabank, we continue to lead the market in terms of reducing interest rates. And we've introduced special things like the production fund. We have special rates for professionals. We have special rates for our consumer loans, and we also have special rates. Our base rate is the lowest in the market, about 2% below. So that has helped us to grow some volumes. Our volume growth was great, and we'll talk about the volume growth a little more. The other variable is the improvement that we showed in impairment losses, because when we have reduced impairment losses, what it means is that we keep more performing loans on the books, and we have an opportunity to grow. If you go to the other slide, impairment losses. Loan losses. Loan losses are down $359 million quarter over quarter, and that's really fantastic considering the trend over the last year, and down $310 million year over year, and I think that's great. That also is a function of several things. It's a function of credit card write-offs. Credit card write-offs plagued us a lot over the last few years. Those are down because we have had more aggressive methods of collection. We are going through collection agencies. We're taking legal recourse where possible, and this has also resulted in increased recoveries for us. When you net them off, then you're showing lower credit card write-offs overall. And I think that the strategies that we have had here are also seeing some improved attitudes towards loan repayment or credit card debt, which is a good thing. On the retail side, we have earlier recognition methods that we're helping our customers to better to plan their manage their finances. As a result of which we have seen a slowdown in retail loans that are going into the non-performing category. Over the last 2 years, we experienced significant growth in that, and over the last quarter, we have seen real tremendous improvement with that. On the small business side, we remain stable because we are focusing on educating our customers. We're teaching them proper record keeping. We're teaching them proper accounting. We've given a lot of them like QuickBooks to help them to set up their accounting stuff. So one of the things that we're also teaching them is to understand the difference between cash flow and profit. And I think that has been able to help them to manage their things better, pay their loans better, and that has helped with non-performing loans On the corporate and commercial side, we have close management of the portfolio to make sure that we recognize very early where there are going to be problems and put in problems for the management to help us to have some kind of workout solutions. And the result of that in this last quarter was that we're seeing lower provisions on our commercial book, which is great. On the expenses side, expenses overall in this market is down $48 million quarter over quarter, and I think that's really very commendable. You will look at the top and at the bottom, and you will see like staff costs. Staff costs is up by $119 million year over year. That is not too worrying for us because that is the new round of staff salary and benefits increases that kicked in during the year, and that was about an 11% increase. And why we're proud of this whole expense containment is that although we had an 11% increase, we were able to contain the year-over-year growth to 3%, simply because we have controlled overtime, we have controlled extra hours for our part-time people, and more than anything else, we have controlled the numbers. And we've made sure that where we have people working, that they're really needed and that they're working efficiently, which is great. In addition to that, we have continued centralization processes that have improved our efficiency as well. On the other expenses category, those other expenses are down by $167 million quarter over quarter. Last year, Mr. Boyne spoke about skimming. We've done some things to make sure that skimming is down. We're controlling things like stationary costs, marketing and system-related costs. Those costs are down. Communication costs are down. And one of the most important things is that our procurement strategy to make sure that we renegotiate contracts and make sure the contracts are properly priced and so, that has very good benefits for us overall. And therefore, we're on the right track with that, with overall expenses being down. On the net profit side, if you look at the net profit slide here, the net profit for the bank is up $206 million quarter over quarter, and up $193 million year over year. Now, this is driven primarily by loan growth, and not only loan growth, but the good thing about it is also driven by lower loan losses. On the asset growth side, we're up 1.76% or $3.4 billion year over year, and $9.8 billion quarter over quarter, which is very commendable. On the other asset categories, that as you can see from the chart remains flat, but loans is something we need to talk about. We're up $4.5 billion over last quarter, and roughly about the same amount year over year. That is a result of just competitive programs that we use to drive asset growth, particularly in retail, in the car market, in the real estate market, and with forming good partnerships out there where we can have good risks in terms of lending practices, and that has been working out very good for us. Our small business and our corporate and commercial is also reflecting a fair amount of growth. On the securities side, that's stable, nothing to talk about, but if you look at the cash resources, that's also up about $5.1 billion quarter over quarter. This is the result of our investing a lot of the excess liquidity that we have with the Bank of Jamaica. But we can assure you that we don't really want to do that for very much longer. So we're going to go after growth, loan growth, good loan growth, and therefore we expect a lot to happen in terms of seeing our loan book grow over the coming months. In terms of market share, we're really excited about that. Although it's on the loan side, it's a slight uptick. Both retail and corporate and commercial. We're showing some increase there. This is as a result of the very aggressive way in which we have targeted the competition with aggressive rates and innovative programs that a lot of them can't respond to in time before they feel it in their bottom line. On the deposit side, we have basically a similar result there. We're seeing a slight uptick in the deposit market share quarter over quarter, and this is despite the fact that our customers are looking for better returns through other investments in things like investments and insurance products that we offer in other parts of the subsidiaries. But it's commendable that we've been able to keep the market share up on the bank side as well. Year over year though, we're down. We're down a little bit as we continue to manage our foreign currency book in an environment in which low rates and less than aggressive demand for foreign currency loans are there, so we have to be very careful when we manage that book. But overall, that's it. The truth is that overall we are very satisfied with the bank results in terms of loan growth, and that will continue. We are very satisfied with it in terms of reduced loan losses, and we think that will continue as well. We're very satisfied with it in terms of control of expenses, which we saw went down quarter over quarter. And most of all, we're very satisfied that in the end, we had a